In April 2025, the United States introduced a baseline 10% customs duty on all imported goods. 90 days later, partner-specific rates were applied on top of that floor. This forced a reconfiguration of trade routes that had remained stable for decades. While the 10% tariff applies to the specific imported component, the total impact filters through the supply chain based on trade exposure. For industries that rely heavily on imported industrial inputs, this baseline translates to a 2 to 4.5% increase in total manufacturing costs. But modeling the global exposure reveals a structural anomaly. Saudi Arabia's tariff burden is lower than that of its primary manufacturing competitors. By shifting the cost of entering the U.S. market, international trade policy has positioned Saudi Arabia as a competitive node for global supply chains. A Roland Berger analysis compares the global average tariff against the Saudi rate, revealing a 16% variance in Saudi Arabia's favor. This discount applies to heavy industrial exports like fertilizers and chemicals and holds across textiles, aluminum, titanium, and plastics. This 16% gap is an aggregate estimate based on the 2025 policy adjustments. It is not a permanent regulated ceiling. However, as long as these partner-specific rates remain in force on competing nations, this cost advantage reduces the landed cost for supply chains exporting goods to the United States. Saudi Arabia's industrial capacity was not a spontaneous reaction to these tariffs. The physical infrastructure has been under construction since the National Industrial Development and Logistics Program launched in 2019. Deployment speed increased in 2025, driven by 1,660 new industrial licenses, backed by 76 billion riyals in capital. These are not speculative commitments. In that same year, 1,201 facilities physically commenced operations. That pushes the total ecosystem to more than 12,900 operational manufacturing plants. The capital required to build at this scale is increasingly international. By the third quarter of 2025, net foreign direct investment inflows grew 34.5% year-on-year to 24.9 billion riyals. The scale of this external capital confirms that the country has transitioned into a private sector-backed export hub. To compound the external tariff arbitrage, the government engineered a preferential domestic tax environment across 4 fully regulated special economic zones. King Abdullah Economic City handles automotive manufacturing and pharmaceuticals, while Ras Al-Khair is built for shipbuilding and offshore drilling maintenance. Jazan focuses on food processing and mineral transformation. The fourth is a virtual cloud computing zone, requiring operators to establish a corporate headquarters in Riyadh. Inside these zones, the standard 20% corporate income tax is reduced to 5% for up to 20 years. Operators are also exempt from withholding taxes on dividends paid to foreign shareholders and excluded from zakat obligations. By decoupling zone operators from traditional regional tax burdens, the state creates a domestic cost structure that compounds the external tariff advantage. Multinationals are already leveraging this math. The automotive cluster in King Abdullah Economic City is the premier proof of concept, anchored by Lucid Motors' AMP2 facility. Lucid is transitioning the site from assembling imported vehicle kits to complete build unit production, targeting a capacity of 150,000 vehicles manufactured in-country. That volume is reinforced by a public investment fund and Hyundai joint venture, which broke ground in 2025 to target 50,000 internal combustion and electric vehicles annually. A parallel expansion is occurring in food manufacturing. The Jeddah food cluster is building the logistics infrastructure and export capability required to move high-volume consumer goods. Current commitments include Farm Frights constructing a 75,000-ton frozen potato facility in Sudair, and JBS doubling its chicken processing output in Jeddah by late 2026. These capital commitments by global market leaders confirm that the physical supply chain infrastructure is actively executing on the policy design. This momentum is part of a broader regional shift. This matrix tracks how non-oil sectors across the GCC grew from 32. Oman is executing a specific metallurgical and green energy play, anchored by the $1.6 billion United Solar polysilicon plant in Sohar. Meanwhile, Bahrain continues to focus on logistics integration with its neighbors, while Kuwait faces a slower diversification pace. For absorbing displaced U.S. export demand, Saudi Arabia's specific combination of aggressive state capital, geographic scale, and targeted tax relief positions it ahead of its neighbors. Capturing these advantages is not restricted to massive multinationals. The state has engineered liquidity channels specifically to bring smaller manufacturers into the market. The Kafala program provides 75% loan guarantees, mitigating the collateral requirements that typically block mid-tier firms from commercial credit. For capital expenditure, the Saudi Industrial Development Fund issues long-term project financing that covers up to 75% of initial build costs. And for daily operations, an early 2026 digital fund launched by SME Bank, Talid, and Manafa is deploying 1.5 billion rials in working capital. This structured liquidity lowers the barrier to entry, allowing mid-tier foreign manufacturers to rapidly embed themselves into the supply chain ecosystem. For supply chain directors and corporate finance chiefs, these data points create a specific operational mandate. Decision 1 is sourcing. Companies must immediately model whether rerouting exposed Asian or European supply chains through Saudi Arabia captures the 16% tariff gap. Decision 2 is location. Executives planning new export capacity should evaluate the King Abdallah and Jazan economic zones, integrating the 5% corporate tax rate and customs relief into their 10-year capital models. Decision 3 is procurement. Over 700 multinationals have recently established regional headquarters in Riyadh, positioning themselves to leverage local content rules for government contracts. Pulling these 3 specific levers is how executive leadership translates geopolitical disruption into a quantifiable corporate profit margin. The current 16% tariff discount relies on the trade policies of other governments, meaning the arbitrage window is subject to renegotiation or reversal. But even if the global tariff gap narrows, combining the zone dates provides a superior cost baseline regardless of future trade policy. Market share shifts decisively during structural disruption. The firms that move their supply chains early capture the margin. Those that wait will absorb the costs.